See, index funds and ETFs can actually play the role of a navigator.
Even the Oracle of Omaha, that is Warren Buffett, really advocates index investing. So,
What is an ETF? If we list the index fund on stock exchange, it becomes the ETF. But the indexing philosophy remains common across both the formats. Here people feel that index funds and ETFs are passive vehicles. Well, let me tell you, the vehicles are passive vehicles, but there can be various strategies. Nobody possesses a crystal ball that can help see future based on the past data. But at the same time, let me give investors a market mantra with two keywords. Right? First word is Shraddha. Another is while Hanumanji reached Himalayas, Hanumanji got confused of which is the right Sanjeevani booty. So what did Hanumanji do? Hanumanji picked the entire mountain, Nifty Total Market Index.
welcome back to The Passive Edge, the show where we decode investing in a way that's sharp, simple, and designed for the modern Indian investor. I'm your host, Avan Dubash. Today we're talking about something that may sound a little boring, but it is one of the smartest financial tools out there: index investing. Now, let's be honest, the word index doesn't exactly scream excitement, but when you realize that the Nifty 50 has delivered an average return of 12.93% CAGR over the last 29 years, suddenly it starts to matter a lot more. And globally, over $10 trillion is now parked in index funds and ETFs. That is not a small trend. But what exactly is an index? How does it work? Who decides which stocks to buy? And how do you, especially if you're in your 20s, invest smartly? To help us break this down, we're bringing back Hemen Bhatia. He's the ED and CEO of Angel One Asset Management Company, a passive-only AMC that is trying to reshape how India thinks about investing. So Hemen, welcome to the show.
Thanks, Avan, for having me on your podcast.
Okay, so I said this in my introduction. What is an index? Let's just get down to the basics and who really decides what companies make it to the Nifty 50 or the Nifty Total Index?
See, index is a market representative portfolio, and the purpose of an index is to capture the characteristics and so the behavior of a specific asset class or its subsegments. For example, let's take an example. So if we say Nifty 50, what does Nifty 50 represent? Nifty 50 represents the mega large cap companies of the Indian capital markets, and it is designed to capture the large cap portfolio for a particular investor who wants to invest in the large cap segment. Similarly, if you see a Nifty Total Market Index represents almost the entire Indian equity as an asset class. All that an investor needs to do to have equity, Indian equity as an asset class, is buy a single ETF or say an index fund which is benchmarked to Nifty Total Market Index, right? So if I can simply explain you the method part, so many times we feel that there's some complicated methodology behind it. In fact, it's very simple. So in simple words, if I can explain you, stocks which are part of broad market indices are chosen based on the full market capitalization of those companies. Now, how is the market capitalization decided? Market capitalization is nothing but the number of issued shares, whatever are the issued shares of a particular company, multiplied by the exchange price. And now, who decides the exchange price? Exchange price is decided by the collective wisdom of all the participants who are participating and who are buying and selling stocks in the Indian capital market. So, you multiply your issue price with your exchange price, and that is how you get your full market cap. Additionally, so most of the stocks which are part of the index are chosen based on the full market cap. Additionally, there are few liquidity criteria as well which are considered, and the weightages of the stocks which are part of the index are decided based on the free float market capitalization. Free float takes care of the liquidity part of that particular stock so that investors can comfortably buy and sell in the underlying constituent without the hassle of liquidity challenges. But remember, index construction methodology isn't subjective or about gut feel or about likes or dislikes about a specific stock or say a particular sector or theme. All criteria are well defined and they hold good irrespective of market conditions.
Okay. And even the Oracle of Omaha, that is Warren Buffett, really advocates index investing.
Right.
So, can you just tell us what exactly is the difference between index investing and an ETF?
So let me start by giving you a couple of analogies to explain the concept of index funds and ETFs. Okay, a few simple ones. Uh, See, index funds and ETFs can actually play the role of a navigator. Okay, they can play the role of navigator or GPS in the investor's portfolio, which can help them meet their wealth creation goal without getting lost in the activity of which stocks to choose or which fund managers to buy.
Yeah, and we all need some navigation.
Yeah. So you see here, given that if you are invested in ETFs and index funds, your wealth creation goal is easily achieved.
Yes.
Right. Another analogy around it, which I can think of, is index fund and ETFs investing. Index fund and ETF investing is like eating a balanced diet and exercising regularly. It is simple, proven, and very effective over time. But people prefer crash diets and miracle pills. So let me tell you, crash diets and miracle pills are exactly like somebody going and choosing which stock is going to outperform in future, or fund manager choosing which fund manager will help you beat the market, right? So crash diets and miracle pills, they seem more exciting or promise faster results, but let me tell you, they rarely work.
Yeah.
Okay. So now, given that I've given you simple analogies, now let us get into the discussion about the key characteristics of an index fund as well as an ETF. Let us first start with index funds. So one of the key characteristics is it is designed to track a particular index. For example, say a Nifty 50 or Nifty Total Market Index is designed to track the large cap or say the total complete capital market exposure of the Indian securities. Because index fund tracks a particular index, the portfolio of the index fund will have the same constituents which are part of the underlying index which it is tracking. Second is index funds are open-ended. While I say open-ended, you can easily buy and sell index funds anytime like any other open-ended active funds. The expense ratios in case of index funds are relatively lower as compared to active funds, because we don't need a battalion of research analysts or fund managers to do research and then recommend stocks. Whatever stocks are part of the underlying index are part of the index portfolio, and they are very transparent. By transparency, I mean index funds are very transparent in terms of portfolio construction. As the stocks which are part of the index, it is well defined. They are based on a well defined methodology which is already available in public.
Okay.
As I said, it is not gut based. I cannot choose anything what I want to be part of my index portfolio. It should be mirroring the underlying index. Now, having discussed index funds in detail, let me quickly tell you what is an ETF. So if I have to simply explain you what is the ETF, if we list the index fund on stock exchange, it becomes a ETF, right? And an ETF has all the features of index funds. For example, a Nifty Total Market ETF or say a Nifty Total Market Index Fund. Both are just two different formats, right? But the underlying stocks which will be part of a Nifty Total Market ETF or Nifty Total Market Index Fund will be the same which are part of Nifty Total Market Index.
Okay.
This is just an example which I am giving.
Yeah.
Additionally, since ETF is a listed security, all the features which are operational features which are available for a particular stock while are also available for a ETF. For example, you can buy and sell ETFs real time on the stock exchange during market hours like any other stock. You can put limit orders, you can put stop losses. The lot size of a ETF is compulsory 1 unit, and delivery has to be compulsory into demat account of the investors, just like any other stock. So see, Avan, while we discussed about ETFs and index funds, we are not here to create a civil war between index funds and ETFs. In fact, ETF and index funds are just two formats, right, which investors can use based on their convenience, but the indexing philosophy remains common across both the formats. In fact, index funds and ETFs are two rivers flowing from the same glacier, and which is the glacier? Glacier is the indexing philosophy.
Okay, so the glacier is the fact that it is indexing. That is the main point. Now, let's say someone is watching and they say, well, Hemen's making a lot of sense. This is something that I want to do. I want to get into indexing. I want to get into investing in ETFs. How do they go about it? Which platforms do they look at? How do they even begin?
Right. See, ETFs are listed on stock exchange, so investor can buy and sell ETF exactly like any other stock through any of the member brokers. Index funds, like any other open-ended funds, have both direct as well as a regular plan. Hence, the direct plan of the index funds can be purchased. They can be purchased or sold through any of the fintech platforms offering direct plans of the mutual funds. Regular plan of index funds can be bought and sold through AMC registered distributors, which are empaneled with the respective AMC. Additionally, index funds can also be bought and sold through AMC's website, and Angel One AMC offers both direct as well as regular plan for its index fund schemes.
So, what are the various investment strategies that can be implemented via ETFs or index funds?
See, many times people feel that index funds and ETFs are passive vehicles, but let me tell you, the vehicles are passive vehicles, but there can be various strategies which can be actively implemented using index fund and ETFs. So, the first which I can think of is you can very easily practice asset allocation. Now, let me explain to you this in detail. If some investor wants to build a passive only portfolio diversifying across equity, fixed income and commodities, now how do you capture equity as an asset class in one single fund? I'll say simply go ahead and buy a Nifty Total Market ETF or an index fund.
Yeah.
Provides investors exposure to the complete equity capital market segment, and it is a representative of equity as an asset class, right? Similarly, you can buy gold or silver ETFs or fund of funds to get the commodity exposure as part of the overall portfolio. And there are multiple fixed income ETFs as well to do the cash management or build a debt portfolio. So investors can very easily practice asset allocation because ETFs and index funds represent a particular asset class. Another strategy which I can think of is cash equitization. Now, what is cash equitization? Globally, this is a very popular strategy. Simple, if I have to explain this in simple words. So, suppose there's any fund manager or any investor who is into buying and selling stocks. Now, you sold some stock and have not decided on the next move. At the same time, you do not want to miss on the market movements, right? Till the time you decide the next move, what do? You simply go ahead and buy a particular index fund or ETF which is representative of the equity as an asset class. That is what is called as cash equitization, so that you don't miss the market moves till the time you decide the next move, next stock which an investor wants to buy. Core and satellite, very critical strategy. Let me tell you, while having conversation with a lot of investors, we recommend investors that this should be part of every investor's portfolio. This strategy should be followed. Ideally, an investor's portfolio should be divided into core and satellite. Now, what is core? Name itself is core, right?
Yeah.
The core should capture the beta of the market. What is beta? Beta is nothing but your market movement, and market movements, the market returns, can very easily be captured with the help of ETFs and index funds. Satellite can be anything which an investor or advisor feels can generate alpha. Alpha is what? Beating the markets. But let me tell you, many times investors under the quest of catching the alpha, they miss the beta as well.
Yeah.
Beta is in front of you. Capture it in a low cost way. Alpha will keep changing hands, right?
Yeah.
But divide your portfolio into core and satellite and let your core be beta of the market, that is ETFs and index funds. One more strategy which can be implemented using passive funds is somebody can actively trade ETFs. So if some investor wants to buy and sell different indices in the cash segment of the market, now you do not have futures and options on every index, right? Somebody wants to buy, suppose, a pharma segment. Now, rather than choosing a particular stock from the pharma sector, you can buy the entire pharma ETF. Okay, so you buy the entire segment, entire sector. If you have a tactical view on, say, a pharma sector, once the view fructifies, you can sell it. Similarly, there can be various sectoral ETFs which investors can use. So they can also do trading via these ETFs. So ETFs and index funds, in short, are very versatile and they have multiple applications.
Okay, absolutely. And I just want to understand, is the data really supporting this? Is ETF investing and index investing actually beating active investing? What does the data suggest?
This is a very interesting question, and so let me tell you, our internal analysis very clearly shows that almost majority of the fund managers are underperforming or unable to consistently beat the appropriate indices if compared on apples to apples basis over different time horizon. And let me tell you, actually, the case of active investing is weak, whether it is short term or long term. However, for a 20-year investment horizon, I believe there is absolutely no advantage of investing in active funds. Let me explain this to you in detail. Why am I saying this?
Yeah.
We look at past performance, data analysis, numerous ratios, which we believe will help us select the future winners, right? But in investing, tell me, Aman, do we have the luxury of knowing which stocks or individual fund managers which did well in the past will also keep doing well in the future, and that also on a consistent basis over next 20 years? Do we know that? I don't think so. We know
No,
that, Avan.
we do not.
So nobody possesses a crystal ball that can help see future based on the past data. But at the same time, in a broad market index like say Nifty Total Market, an investor is likely to get the market returns. Whatever be that market returns, investor will surely get the market return subject to the tracking error, etc. And market return helps investors beat the inflation, which should be the primary goal of any investor who is entering the equity markets. The objective of equity investing is not to keep forecasting or guessing future winners, be they stocks or individual fund managers. Nobody can do this consistently. Believe me, nobody can do this consistently based on the past data. Hence, especially for young investors who are entering the workforce, I believe there is no alternative to broad market passive investing. As I mentioned in the part 1 of this podcast, let me reiterate that passive investing is not only for beginners. It is for the market veterans too, for the reasons I had mentioned. And on the lighter note, let me give investors a market mantra with 2 keywords, right? First word is Shraddha. Another word is Saburi. Investors can create wealth and benefit from India growth story by keeping Shraddha in the Indian economy, and Saburi, patience which is required for long-term investing.
Kya baat hai. You've put it very well. And you know, the fact that Angel One AMC is a passive only AMC. What prompted this unique approach?
See, I and my team have been fortunate enough to be part of the entire journey of passive investing in India due to our association with Benchmark AMC, which pioneered this space in India.
Okay.
Hence, we've seen the metamorphosis of passive investing right from embryonic state to now when it is in a high growth phase. And we believe we are at an inflection point where passive investing will establish itself as a core component of the portfolio construction. The reason for being passive only AMC is because, see, active and passive are totally 2 different investment philosophies. And if both are offered together, we believe it sends a conflicting signal to the investors. Hence, we believe that going all passive ensures no conflict of interest, ultimately benefiting the clients, and as the right kind of the education required for educating the clients about the advantages of passive funds. It can be imparted in an unapologetic way only if I am running a passive only AMC. Yeah?
Absolutely, because that's the only way you'll really see the alpha, if you will. So, you know, say that there are still some naysayers out there who say, no, I'd rather go the active investing route. What is your closing argument, or what would be that thing that you think will really convince them?
So, I would like to conclude this session by giving an example from Ramayana. Okay. Where actually the seeds of indexing were sown. Okay. So, if you remember, if you would have seen Ramayana on our television, when Lakshmanji was injured, Hanumanji was sent to pick up Sanjeevani booty. Okay. So, at Himalayas, he was sent to Himalayas. So, while Hanumanji reached Himalayas, Hanumanji got confused of which is the right Sanjeevani booty. So, what did Hanumanji do? Instead of getting confused in which stocks or which fund managers to choose, Hanumanji picked the entire mountain, Nifty Total Market Index. right? He picked the entire mountain, and that is how Lakshmanji was saved. And let me tell you, if Hanumanji would have wasted time picking the right kind of Sanjeevani booty, that is which stocks will outperform in future or which fund managers will outperform in future, Lakshmanji would not have survived, right? So the message,
Yes.
Avan, I am trying to convey is, don't waste time in searching alpha, choosing the future winners. Rather capture the beta, that is market returns, in a low cost way via ETFs and index funds. I would also like to quote an American economist who has won a Nobel Prize. He says that the creation of first index fund was the equivalent of the invention of the wheel, the alphabet, and wine and cheese.
Oh, wow. So from the Ramayana to everyone, overseas also quoting the importance of index investing is really making for a strong case. So you're saying that this is absolutely the way to go, right, Hemen? Thank you so much
Thanks, Aman.
for joining in. And I think even for younger investors, older investors, those who don't have the time, the patience, or the bandwidth to even go about these investment decisions, I think this would definitely be the way to go.
Definitely.
All right, Hemen, it's been a pleasure interacting with you. Thank you.
Thank you, Avan. Thank you.
So that was Hemen Bhatia giving us a clear, jargon-free look into the world of index investing and why it might be the smartest financial decision that you can make no matter what your age is. Here is the bottom line. You don't need to beat the market. You just need to be in the market. And with tools like ETFs and index funds, you are no longer on the sidelines, but you're actually tracking India's economic growth directly. If you find this episode of Passive Edge useful, do follow the show, share it with someone who's thinking about getting started. Until then, I'm Avan Dabash. Stay curious, stay consistent, and let compounding do the rest. Thanks for watching.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.